Bloomberg Opinion columnist Mohamed El-Erian weighing in on the potential policy response, saying slowing growth will force the Fed to rethink its rate hike path, saying, quote, "The question now is not whether and when the Fed will change its official quantitative policy guidance, but how much it will do so as it moves away from the current path of 2 rate hikes in 2019 to a new baseline of no hikes in 2019 and a balance of risk towards a rate cut in 2020. Mohamed El-Erian joining us now from Washington. Mohamed, always great to catch up with you. Walk us through your thinking then on the potential Fed response through this year.
Well, first, I repeat, it's not about a recession in the U.S. The chances of a recession in the U.S. are very low. This is about what's happening in the rest of the world, where there's a significant weakening in Europe and in China with the possibility of spillback. This is about muted inflation in the U.S. This is about the Fed not wanting to take on the markets again, and this is about evidence of slack. So when you put all that together, even though the U.S. economy will continue to do well, the Fed is likely to stay on hold for this year, and the balance of risk is towards a cut for next year.
So, Mohamed, that doesn't sound like a recipe for cutting interest rates, though. Walk me through the potential catalyst that leads the Fed to turn around from taking a pause, into an interest rate cut. What is it?
It is spillback from what's happening abroad. You don't see much happening in Europe in terms of pro-growth policies, and you're unlikely to see much because of the politics. The EU just revised downwards significantly its growth projections, with all 4 major economies taking a hit, and it's likely that the growth prospects are going to dim even further. In China, the typical stimulus measures aren't producing what they used to. So it's about the rest of the world.
So, Mohamed, for the ECB, and you've mentioned the ECB, and actually I think you've been quite critical, it's fair to say, over the last couple of months of the European Central Bank. For me, for the Federal Reserve, it was about a policy mistake 2 months ago. And now for Europe, it's about policy impotence. I'm not sure, Mohamed, what the ECB or European officials can actually do to counter the slowdown there. Are you?
Well, first, I'm puzzled. We got 2 comments that Bloomberg News covered well from ECB officials, basically dismissing the weakness. One calls it a soft patch. The other one saying we shouldn't overreact to data points. No, this is a widening slowdown in Europe, and it has to be taken seriously. In terms of policy responses, you're right. Interest rates are already negative. I mean, they can possibly delay what they've told us about possible rate hikes, but it's about other policymakers. You had today the Minister of Economy from Germany, and he is in a country that just averted a technical recession, running a budget surplus, and yet the fiscal response is very limited.
Yet we seem to have a continent that when you have a low-growth story, it makes it even less likely that they introduce some kind of fiscal stimulus. Mohamed, is there anything in the politics, anything in the political tea leaves in Europe that you see that would push the Europeans to change their pro-cyclical fiscal impulse? Is there anything there at all?
Not as yet, Jonathan. I think it would take a major slowdown for the politicians to respond. I mean, that is one of the risks of the central banks having delivered this continuous low growth. It's taking the politicians off the hook. And the result of that is that structural impediments have accumulated, and now we're seeing a renewed slowdown in Europe.
So let's talk about how you express this in financial markets, Mohamed. Quite obviously, a couple of weeks ago, the Federal Reserve did its full 180, formalised it in a full retreat, and there was a lot of people that came out of the woodwork and said, this is about dollar weakness now. It's all about dollar weakness. Are we about to find out it ain't that straightforward?
It ain't that straightforward for the simple reason that economic growth matters for currencies as well. So what I think you're going to see is the return of the divergence trade, where the U.S. assets outperform others. And I think that that's going to include a stronger, not a weaker dollar.
So walk me through this, Mohamed, what the divergence trade through 19 could mean outside of, say, short euro dollar, which is already at 113. What's lagging and what needs to catch up?
So the obvious relative trade is U.S. stocks versus the rest of the world. What we've seen in the recent past is that the rest of the world has done better than the U.S. I think that's going to reverse. Secondly, you've got a interest rate differential in 10-year at about 253 basis points between the U.S. and Germany. That's going higher, not lower. So I would look there in addition to the currency.
How much lower can that go, Mohamed? That's going to be shocking to a lot of people, given where the German 10-year yield is right now. How much wider can that spread get?
Well, we can go all the way back to 270, almost 280. We were there a few months ago.